What if the first thing you saw on the news today was the US national debt ticking past $36.1 trillion? The reality is that this is a figure that keeps growing by the second, and it's climbing so fast that by the time you finish this video, it will be millions higher. If every American were responsible for paying it off, each person would owe more than $108,000, a reality that underscores the staggering weight of the country's financial obligations. Yet, despite this colossal debt, the US economy appears strong. Stock markets are surging, unemployment remains low, and the dollar continues to dominate global trade. How is this possible? The answer lies in a financial system built on trust, borrowing, and the unique status of the US dollar as the world's reserve currency. For decades, the US has financed wars, economic bailouts, and trillion-dollar stimulus packages by borrowing against its future. The assumption: debt doesn't matter as long as the US remains the safest investment on the planet. But what happens if that confidence begins to crack? China and Japan, two of the largest foreign holders of US bonds, have been reducing their exposure, a sign that some global players are hedging their bets. Meanwhile, rising interest payments are forcing the US to borrow just to cover past debt, a cycle that is becoming harder to sustain. The question isn't just how much debt the US has, it's whether the world still believes in its ability to pay it back. If that trust fades, could this debt spiral trigger an economic disaster? So, as always, we have some questions to answer. How did the US get into debt? The United States wasn't always drowning in debt. In fact, for much of its early history, the federal government operated with relatively little borrowing. But war changed everything. The Civil War, World War I, and World War II forced the US to borrow heavily, creating the foundation for a national debt that never truly disappeared. By the time the Cold War came along, military spending had become a permanent fixture of government budgets, ensuring that debt would only climb higher. Then came the tax cuts. The 1980s ushered in supply-side economics, a belief that lowering taxes would spur economic growth and ultimately balance the budget. Instead, government revenue fell while spending surged. The Reagan administration nearly tripled the national debt, marking the beginning of a dangerous trend, spending more than the country earned. The debt problem worsened in the 21st century. The 2008 financial crisis forced the US government to inject trillions into banks, corporations, and financial markets to prevent economic collapse. The national debt skyrocketed, but it was nothing compared to what came next. In 2020, the COVID-19 pandemic triggered the largest wave of government borrowing in US history. With businesses shutting down and unemployment spiking, Washington responded with trillions in stimulus packages, emergency unemployment aid, and corporate bailouts. By the time the crisis stabilized, the US debt had surged past $30 trillion, and there was no turning back. But why does the government keep borrowing? The answer lies in deficit spending. Every year, the US government spends more than it collects in taxes, making up the difference by issuing bonds. The debt ceiling, which is supposed to limit borrowing, is routinely raised by Congress, effectively giving the government a blank check to accumulate more debt. The debt ceiling, a limit set by Congress to control how much the US can borrow, is routinely raised whenever it is reached. This is because failing to raise the ceiling doesn't stop new spending. It simply prevents the US from paying for obligations it already owes. In other words, if Congress doesn't raise the ceiling, the US wouldn't be able to pay its existing debts, risking a default on its financial commitments. Raising the debt ceiling ensures that the government can continue to meet its obligations, but it also opens the door for more borrowing, which is why the debt continues to climb. This brings us to the fundamental economic debate: how should a government handle debt? Keynesian economists argue that borrowing is necessary during downturns to stimulate growth, while supply-side economists believe cutting taxes and reducing government intervention is the best path forward. In reality, both strategies have led to higher debt without a long-term solution. Now, the question remains, has America crossed the point of no return? With interest payments on debt becoming one of the government's largest expenses and foreign investors growing wary, is there any way to reverse the course? Or is the U.S. simply delaying the inevitable? The United States borrows at an unprecedented scale, but who exactly is lending it the money? Contrary to popular belief, the largest holder of U.S. debt isn't China or any foreign power, it's the American people. Domestic investors, institutions, and government agencies own the bulk of U.S. Treasury bonds, making up nearly 70% of total debt holdings, according to Visual Capitalist in 2024. The Federal Reserve, tasked with stabilizing the economy, is a major player. Through a process called quantitative easing, it buys government bonds to inject cash into financial markets. This helps keep interest rates low, but also means the central bank is one of the biggest creditors to the U.S. government. Beyond the Fed, Social Security and pension funds are among the largest domestic holders of U.S. debt. When workers pay into these programs, a portion is invested in Treasury bonds, essentially making future retirees creditors to the government. This setup allows for a steady flow of funding, but also means the financial security of millions is tied to Washington's ability to manage its debt. While domestic investors dominate, foreign governments still hold a significant stake in America's financial future. Japan is currently the largest foreign creditor, holding $1.1 trillion in U.S. bonds, followed by China with $768 billion, and the UK with $723 billion, according to the latest U.S. Treasury report. These nations buy U.S. debt because of its historically stable returns, but recent trends suggest that trust may be weakening. China, once the largest foreign holder of U.S. bonds, has been steadily reducing its holdings, diversifying its reserves into gold and other currencies. Other countries are following suit, as concerns grow over America's rising debt and political gridlock. If more foreign governments decide to offload their U.S. debt, it could drive interest rates higher and weaken confidence in the dollar. So, what happens if foreign nations lose faith in America's ability to manage its debt? The sell-off of U.S. bonds could send shockwaves through global financial markets, forcing the U.S. to raise interest rates to attract new buyers. This would make borrowing more expensive for both the government and ordinary Americans, leading to ripple effects across the economy. For now, investors still see U.S. debt as a safe bet, but the question remains: how long can that confidence last? Debt by itself isn't necessarily bad. Our governments borrow to invest in infrastructure, healthcare, and national defense. But when debt grows faster than the economy, it triggers a dangerous cycle that can destabilize financial markets, crush public investment, and weaken the US dollar's global dominance. One of the biggest consequences of rising debt is soaring interest payments. The US now spends over $1 trillion annually just to pay interest on its debt, more than its defense budget as reported by the Congressional Budget Office. As borrowing increases, the government must allocate more funds to servicing debt instead of investing in education, healthcare, or infrastructure. This crowds out vital public spending, limiting long-term economic growth. Then there's inflation. When the government borrows excessively and the Federal Reserve prints money to absorb that debt, more dollars flood the economy, eroding purchasing power. The U.S. has already witnessed inflation hitting 40-year highs, forcing the Fed to hike interest rates, which slows economic activity and increases borrowing costs for businesses and consumers alike. But the greatest threat? A loss of investor confidence. The U.S. relies on global investors to buy its bonds, but as debt skyrockets, doubts begin to emerge. If foreign governments, pension funds, or private investors start demanding higher returns due to rising risk, the U.S. will have to raise interest rates even further to attract buyers, creating a vicious cycle of borrowing at ever higher costs. History offers chilling reminders of what happens when debt spirals out of control. Greece's 2010 debt crisis serves as a stark example. The crisis led to mass unemployment, with jobless rates soaring to unprecedented levels. Bank withdrawals were restricted, leaving citizens unable to access their savings freely. Pensions were slashed, causing widespread financial hardship, especially among the elderly. These austerity measures imposed as part of bailout agreements triggered nationwide protests and social unrest, while the economy endured a prolonged recession that took years to recover from. Argentina defaulted on its debt multiple times, forcing its government to impose currency controls and restrict bank withdrawals. Even Russia in 1998 saw its economy crumble when it could no longer finance its obligations, leading to a currency collapse and financial turmoil. The difference? Unlike these countries, the US controls the world's reserve currency, giving it an advantage for now. But if confidence in US debt deteriorates, a similar fate isn't impossible. So the real question is America on the same path? If debt continues rising unchecked, could the world's biggest economy face a crisis of its own? And more importantly, how much longer can the US delay the consequences? For decades, the US dollar has been the backbone of global finance, acting as the world's reserve currency. Countries hold US dollars in their central banks, trade oil and commodities in dollars, and settle international transactions using the greenback. This dominance allows the US to borrow cheaply and maintain economic influence worldwide. But what happens if that changes? A growing number of nations are actively seeking alternatives. The BRICS alliance, Brazil, Russia, India, China, and South Africa, has intensified efforts to reduce reliance on the US dollar, according to the BPC report in 2024. These countries have increased trade in local currencies, developed alternative payment systems, and even discussed launching a BRICS-backed currency to rival the dollar. China in particular has taken aggressive steps to de-dollarize. Once the largest foreign holder of US debt, China has been steadily reducing its holdings of US Treasury bonds, shifting its reserves toward gold and other assets. At the same time, Beijing has expanded the use of the yuan in global trade, striking energy deals with Saudi Arabia and Russia that bypass the dollar entirely. The question is, does this pose a real threat to the dollar? While BRICS nations are pushing for de-dollarization, the US dollar still accounts for nearly 60% of global foreign exchange reserves, making it the most trusted currency in the world. However, if confidence in US debt continues to decline and more nations find ways to trade without the dollar, the global financial order could shift. The US has long benefited from what former French President Valéry Giscard d'Estaing called its exorbitant privilege, the ability to print money and borrow in its own currency without consequence. But history shows that no global reserve currency lasts forever. So is the dollar truly at risk? For now, it remains the world's dominant currency. But if de-dollarization gains momentum, could the financial world be on the verge of a seismic shift? The US debt crisis is clear, but is there a way out? Economists and policymakers have floated multiple solutions, yet each comes with its own set of challenges, trade-offs, and political roadblocks. One of the most obvious solutions is cutting government spending, but that's easier said than done. Social Security, Medicare, and defense spending make up nearly 70% of the federal budget, meaning any meaningful reduction would require slashing these politically sensitive programs. No party wants to take responsibility for cutting benefits, making spending reductions a tough sell in Washington. The other option? Raising taxes to generate more revenue. Some economists argue that increasing taxes on corporations and high earners could help balance the budget, but opponents warn that higher taxes could slow economic growth and discourage investment, ultimately worsening the debt problem. The reality is that spending cuts and tax increases are both politically unpopular, which is why neither has been seriously pursued. So what about economic growth? Could the US simply grow out of its debt? In theory, a booming economy would increase tax revenues without raising tax rates, helping to shrink the debt to GDP ratio. However, historically, High interest rates and slowing productivity growth make this a difficult strategy to rely on. Unless the US can sustain long-term economic expansion at an unprecedented pace, growth alone won't be enough to erase the debt burden. Then there's the most controversial idea, modern monetary theory, MMT. The belief that a country that controls its own currency can print money indefinitely without worrying about debt. Proponents argue that as long as inflation is managed, the government can continue issuing money to fund public programs. However, critics warn that excessive money printing leads to inflationary spirals, eroding the value of the dollar, a risk the US is already facing after years of aggressive stimulus policies. So, can the US actually fix its debt problem? The harsh truth is that there's no easy solution. Politicians avoid spending cuts, tax hikes carry economic risks, and betting on growth alone is uncertain. Printing more money might delay the problem, but it could also make things worse. The real danger isn't just the debt itself, it's the growing unwillingness to address it. As the numbers climb higher, the US is left with a difficult question. Will action come before a crisis forces it? With the US debt spiraling past $36 trillion, inflation chipping away at purchasing power, and foreign governments quietly shifting away from US bonds, many are asking, is America on the verge of an economic crisis? Some experts warn that the warning signs are impossible to ignore. Rising debt means rising interest payments, and the US now spends over $1 trillion a year just to cover interest, more than it spends on national defense. If borrowing costs continue increasing, the government may be forced to cut social programs, raise taxes, or print more money, each with its own economic consequences. Then there's the threat to the dollar. As BRICS nations push for alternative currencies and China reduces its US bond holdings, the world is slowly diversifying away from dollar dependency. If confidence in the US economy weakens, a sell-off in US assets could trigger market instability and a potential debt crisis. However, not everyone believes disaster is imminent. The US dollar still makes up nearly 60% of global foreign exchange reserves, reinforcing its dominance in international finance. Unlike Greece or Argentina, the US controls its own currency, giving it unique flexibility in managing debt. Some argue that as long as America remains the world's economic leader, investors will continue buying US debt, keeping the system intact. So, what's the truth? Is the US trapped in an unsustainable debt cycle, or is this just another economic phase that policymakers will navigate as they always have? History has shown that the global financial system is built on confidence, not just numbers. But confidence isn't permanent. If that trust erodes, could this be the moment the world finally questions America's financial dominance? The US debt crisis is a ticking clock, but is it counting down to disaster or just another economic cycle? Some believe America's dominance will endure, while others warn of a reckoning on the horizon. What do you think? Is the US economy too big to fail? Or are the warning signs too big to ignore? Drop your thoughts in the comments. We're listening.